So it was a bailout of sorts for Europe, led by the US. But is it to be the first of many and the prelude to a lot of money printing by the European Central Bank? Well, I'm joined now by Manoj Ladwa, senior trader at ETX Capital in London. Manoj, tell me, despite everything and the Asian markets rallying, the European market London market seems to have come off. Is this because of the new data on Chinese manufacturing, which show a shrinkage for the first time in 3 years?
Absolutely. I mean, this all doesn't seem to be well in China at the moment, and the Chinese economy being the number 2 in the market, everyone's looking for them to spur growth onwards and upwards within the Eurozone and across the rest of the globe as well. And if they're slowing down, we're feeling the impact over here. But we've also got to remember that the market had a fantastic day yesterday, certainly the equity markets, and today's the hangover. Everyone's looking to see what will happen next and mull over the events over the last 24 hours or so. Although there is that short...
I was going to say, sorry, the Chinese central bank actually lowered the reserve ratio just before we heard about these manufacturing figures. Do you think that was because China was quite surprised at the slowing down?
Absolutely. The Chinese economy is slowing down. We see manufacturing, certainly from numbers today, slowing down. We're seeing the property markets in China, in a number of regions across China, slowing down as well. And where a large amount of Chinese money is going into property, if the market there is slowing down, it's going to impact on consumer spending as well. So that move yesterday by the Chinese central bank could just be the first of many moves, and we could start to see interest rates begin to come back down in China as well.
Do you think that this federal-led intervention is anything more than a band-aid? We just heard in our little piece before that it's not going to fix the euro crisis, and the message really seems to be that these central banks have come in where the market has given up.
Well, absolutely. There's a crisis in confidence when it comes to the Eurozone, and Eurozone ministers haven't been able to raise the necessary funding in order to prop up the market over here and support the sovereign debt market. And therefore, the Federal Reserve got to a point whereby it had to intervene, and coordinated action was required in order to prevent another credit crunch, which, if it's not already happening, is likely to happen in the very near future. But this is a short-term measure. As you say, it's a band-aid on the situation, and we could find that the sovereign debt problems do not go away, and that the markets continue to remain volatile.
So what is left? I mean, what sort of pressure now is on the ECB and Germany? Do you think there's enough for it to move finally?
Well, there's basically one of two options. It's either the Eurozone is broken up into its various components, individual countries, especially the weaker ones, which probably shouldn't have been allowed to enter the Eurozone, get pushed to the wayside, start back on their own, revert to their own currencies, and get bailed out by the IMF. Or we go down the other routes whereby there's more integration, fiscal integration, and possibly a Eurozone bond as well. But then you require massive changes to the treaty.
All right, Manoj Ladwa, thank you very much. The situation keeps moving.